Hello everyone, this is the second session of our Crypto Special. Thank you very much for all the kind messages that you've sent us. Your feedback means a lot to me. In the first session, we have covered the basics of the Wyckoff method, and today we will discuss also two very important concepts, comparative strength and the anatomy of momentum. We will also review together the analysis that I published last Saturday in the Crypto Report. So today's lessons will be more interactive, and I will show you a couple of exercises too. As usual, everything we discuss in this class is for educational purposes. Please stop the video and read the disclaimer. So let's start today with a very basic question that I received by one of the students of this class. What's the first step in the analysis of the crypto market? In the crypto report, I usually start my analysis with a weekly chart of the S&P and Bitcoin. We want to define the big picture of the market. Many traders today use two indexes that we can easily find on TradingView: Total and Others. These two market cap indexes are calculated by TradingView. The first one is the index of the global market cap, Bitcoin plus the altcoins universe. The second index represents the low caps, the most speculative crypto assets. As you can see, both indexes shows a multi-year consolidation almost in sync with the S&P. After the 27 hypodermic, the majority of altcoins have experienced 80% losses. When the whole crypto market is in the markdown phase here, holding a position to the highly speculative low caps can really destroy your portfolio. And you can see this in the first part of the chart. This is another reason to always keep in mind the big picture of the market. That said, the crypto market is so vast, and there are thousands of low caps today, and just looking at these two indexes do not tell the whole story. I'm not a big fan of these two indexes. I think that they are very good for long-term analysis, but this is a very speculative environment where a lot of new assets are listed every day, crypto companies fail to reach their goals and are replaced by new projects, and that can happen in just a couple of years. So it's a very competitive scene, and capital quickly rotates from one asset to another. If you just focus on two indexes, you will miss a lot of opportunities. For example, in this picture, you can see Bitcoin at the top of the chart and Chainlink in the middle. The third asset is ICX Icon. Bitcoin is still today the most capitalized cryptocurrency. It's the oldest time-tested cryptocurrency. It has very good financial gateways, CME futures, over-the-counter desk for big institutions, and so on. When the global markets are in risk-off mode, we generally notice a kind of flight to safety from very, very speculative crypto assets to the king of the crypto ecosystem. However, as you can see, Chainlink was holding much better than Bitcoin during the 2018 bear market. This outperformance still continues today, and Chainlink is one of the leaders of the crypto industry in the current market cycle, and we will talk about this structure later. The chart on the bottom, ICX, shows a very severe downtrend throughout 2018. This is a logarithmic scale from $10 to 1 cent in just 1 year. Oh boy. Same sector, 3 different charts. Speculators in this market need much more detailed information than just these 2 indexes. The total and this, basically. Others, totals and others. It's a matter of preference, by the way. But later I will show you more modern indexes to track the crypto market with good volume data, indexes that you can use right away in your everyday trading routine. Now a very common question. There are so many crypto exchanges today. Sometimes 2 crypto exchanges have different volume data. What ticker do you use? As Wyckofians, we always want to track the activity of institutional traders. Crypto fans love to trade in very liquid platforms like Binance, Kraken, BitMEX, and Coinbase. BitMEX is still today the most important derivative platform in the crypto space. This is the place where giant crypto funds professionals move a lot of money speculating in this market. But do you see any significant difference in the volume data here, guys? Here, 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 here. As you can see, the volume signatures on the daily charts of these major exchanges are very, very similar today. On the intraday, you can sporadically find some difference in the volume signature, there is no doubt. But at Wyckoff Analytics, volume is our specialty, and I personally look at this volume data every day, and there are no excuses today to not trade these instruments. In the altcoin market, sometimes it's a bit hard for beginners to find the right data because some assets are more traded in the US exchanges, while other assets are traded mainly on Asian exchanges, and so on. Here's a very simple trick that will save you a lot of money and time. I highly recommend this charting platform for cryptocurrency, Messari.io. You can just use the free version. There is no need to subscribe to the pro version. Just type the name of the crypto asset that you want to analyze in the search box, in this case Cardano, ADA. Then you go to indicators, add volume chart, and that's it. You have the full data history of 90% of crypto assets, and the volume data that you see on the charts has been aggregated from several exchanges. This is very important. In this way, in one place, you get the whole history of the crypto assets with the best volume data for free. The volume data that you see on this website is, for me, the most accurate. They don't have point-of-figure charting, but you can find that on TradingView and StockCharts. StockCharts.com is the best platform for point-and-figure charts. So here's my classic perspective on Bitcoin and the S&P. As we have said in our first session, Bitcoin is a good barometer of the speculative sentiment of the market. Where the financial conditions are uncertain, money managers reduce their positions in the most risky asset classes. Look how Bitcoin often anticipates top and bottom of the stock market. Here, here, here. And in the previous session, we have analyzed the previous 2 market cycles. Now let's recap the price history of the current consolidation. I have discussed this consolidation many times in the crypto conference on StockCharts TV, so let's be very quick. Guys, what's the name of the price action at point? Let me change the slide. At point 1. Please write in the chat box. Point 1. At point 1, we see a classic hypodermic top, a formation where institutions have urgency to sell. Speculators and newbies are punished. We have analyzed in depth this distribution in our previous session. A downtrend starts, all the media cover very bad news for Bitcoin. Every newspaper title, "We say that Bitcoin is a scam. If you want to invest, buy stocks." Ironically, just a couple of weeks later, we see a big correction in the stock market. The distribution in Bitcoin was a first signal that CEO types were limiting their exposure to risky assets. This is the start of a multi-year consolidation in the S&P. Huge consolidation. Now, what's the name of the event at point 2? Here, please write. Point 2 here. Great. Selling climax. The price area around 6,000 is very important. It's an important value zone for institutions active in this market. Value buyers step in, automatic rally at point 3. At point 4, what's the name of this event? Great, secondary test. Now look at the decrease in volume at point 5 in this area. Very often, after such an hypodermic top and a very aggressive downtrend, trend followers are scared by this market and they do not participate. These lackluster rallies on decreased volume indicate low institutional participation. We will explore the same pattern also in the small crypto caps, where after an initial speculative phase, market participants fly away, price stalls, weekends capitulate, and the CEO step in and absorb the supply on the way down. Point 6. In this context, price collapses to 3,000. This is a very oversold area. Massive volume. Look at the S&P. Bitcoin is anticipating the bottom of the S&P. Beautiful. Is this action a potential absorption? Yes, we see a lot of absorption here. But is this price action enough to say this is an accumulation? No, that's a big question mark at this spot. The up bar at point 7 answer our question and confirm the accumulation bias. And we will review this accumulation range in a very detailed way in the final part of the session, but let's just focus now on the big structure. Point 8, big volume and then stopping action. Institutions are taking profit. We are not ready to break the level of the automatic range. We still need to absorb the supply at this level, and there's a huge amount of supply here. At point 9, we see some kind of absorption, the increasing spreads and volume. And this is a very important price level. We'll say that around 6,000, there are a lot of value buyers that usually want to buy Bitcoin. And then what we see, the selling pressure of the market, and just look at this very horrible price action here during the COVID crisis, affects Bitcoin as well. But what do we see at point 10? Shakeout, followed by a quick recovery in both the S&P and Bitcoin. Oops. Okay. So this is the chart that I published in the last crypto report. What's the logic here? First observation. We are in an uptrend on the S&P. Quick momentum move, absorption on the way up, change of character, reaction on the top of the capitulation bar. We are in a consolidation. Same story for Bitcoin. The consolidation of Bitcoin has started before the S&P. Risk of moat? Not yet, because money has rotated into the small crypto caps, and we will see this later. On the daily, this is another chart published on the crypto report, and I want to show you the logic, the process here. We are currently in a consolidation. Our bias at this point, and we are talking about a chart published Saturday, was still bullish. The path of least resistance was still to the upside until supply came into the market. At this point, at this specific spot, do you see any evident signs of distribution of supply? Please write. Yes or no? Perfect. No, we don't see any distributional sign for now. And let me say that it's very common, especially for young traders, to have some kind of permanent bearish bias. I've made too this mistake in the past, at the beginning of my journey to the Wyckoff methodology. My suggestion is always print the chart. Think of both scenarios. Then draw the points of confirmation for the bearish and bullish scenario. Draw the price action that would invalidate your analysis. Price and volume bars. Try to imagine all the possible price actions. All these possibilities are already in your head, like an unshuffled deck of cards. But it's actually when you draw all the points of confirmations that you start thinking like a trader. And your analytical skills too will benefit a lot from this exercise. This is what Roman suggested to me, and I can say that it helped me a lot with my analysis. So this is the chart that I published a week ago. It's a very simple trading plan for Bitcoin. The yellow spot was the day of our previous session on Thursday. Do you remember my message last week? Supply throughout the formation is decreasing, but that day we were underperforming the market. So we have here increased volume, a higher low, a demand tail. So there is some buy in this bar, a potential spring, but this is a high risk point for Bitcoin. If this is a true spring, I want to see a reversal bar, a good confirmation bar, like here. And Saturday published my analysis with a level confirmation that could potentially trigger the trade. What could be the opposite scenario here? Something like this, where we see selling and then absorption on the way down. And people generally switch from the most bullish scenario to the most bearish scenario. My suggestion is always think to the scenario that fools you in the most subtle way. think of the most frustrating scenario. And today we have seen some selling in the market. We are still waiting for a confirmation that probably will come tomorrow or Monday. The price action Bitcoin is not constructive for now. Look at that supply line on the top. Each time his price reaches that level, we see some selling. We want to see a good reversal bar, and we want to see that price breaks the support, the supply line for the first time. This would be a change of behavior. If price fails here, we can just retest the 8,000 level. As you can see, this consolidation is quite boring, almost 2 weeks, and basically just a setup there. That's not what we want, especially if you want to profit in crypto on a daily basis. Why? Because we are considering a position in an asset that is currently underperforming the crypto market. So now let's explain this concept. Look at this decrease in volume here. Where are the market participants? Low volume, low market participation. You are looking at the wrong chart. We want to see another perspective that tells you the full story. This is today's chart, so it's updated. As you can see, we have selling on the leading indexes here and here. Now we want to see more confirmation to understand if today's price action is an uptrust or a sign of strength that is just backing up. In both cases, we have to wait. The last supply bar has increased volume, but we are currently above the resistance and we want to see more confirmation. I will write a full analysis in the crypto report tomorrow, but today I would like to spend more time on the post-analysis of the last week price action, because I want to show the process. So this is the intraday chart of the major crypto indexes that I published in the last crypto report. Little by little, I am introducing you to one of the major topics of today, the comparative analysis. When you watch the weekly market discussion, Bruce and Roman opened the session with the analysis of the main US indexes, Nasdaq, S&P, Dow, and Russell. Here, instead of the Nasdaq, S&P, Dow, and Russell, we have Bitcoin and 3 major crypto indexes: large caps, mid caps, and small caps. These indexes are a new product launched by FTX, a great derivative platform that's totally devoted to crypto. They have been created just a few months ago, but they are very popular, and these crypto futures are still not available in the US market for the average retail investor. But please keep in mind that crypto funds are very smart, flexible, light institutions. They operate in the digital space. They can relocate their activities to other countries in the blink of an eye, and that's fully legal. There are really no boundaries in this financial space, and until the day that we see a systematic global regulation of the crypto ecosystem, crypto funds will just benefit of the current fragmented regulatory framework. They can just choose the country offering better business conditions. I think that new regulations for the whole ecosystem will come at some point. But who knows, maybe they will come after the current price cycle. In the meanwhile, we want to be aware of the characteristics of the current environment and participate into this market. And even when a particular financial instrument is not available in your country, the offering of crypto instruments is so vast that there is always a way to extract gains from this market. And we will talk about this in the third session. So the great news about these crypto futures is that they are traded every day by crypto funds. You can find online the composition of these baskets of cryptocurrencies. Here's a description of the mid-cap crypto futures. As you can see, it's just a basket of cryptos with similar characteristics. The tickers on TradingView for these instruments are ALTPERP for big names, MIDPERP for mid caps, and SHITPERP for the low caps. And personally, I never thought I'd be trading a future contract called Shitcoin Perpetual Contract. It seems to have come straight from a play by Samuel Beckett or Alfred Jarry. And the crazy thing is that not just retail traders use these contracts, but also big players in the crypto industry. Crypto is a very young financial ecosystem, and very often people work in the crypto funds at 30, 35 years old. They get a job at Deutsche Bank, Goldman Sachs, and at some point of their job career, they discover a new financial ecosystem, crypto. Since there is always some kind of resistance on the part of experienced analysts, because this is a very high-tech sector, the crypto industry offers higher wages than their competitors in traditional financial world to attract young specialists. The universe of professionals operating the crypto is almost fully populated by millennials, and millennials create new financial products, services, and even the name they choose reflects their habits, the way they communicate in the internet age. Now, just try to explain to a friend, I'm trading the shitcoin index. I'm sure that he will call an ambulance. And this phenomenon accentuates the generational gap in the crypto industry. I personally think that this generational gap is a shame because I strongly believe in the power of the transmission of knowledge between people of different generations. Wyckoff is just a great example of a century of dialogue between traders of totally different eras. And young traders could learn so much from the history of the market, while experienced investors could just test their models with these high momentum instruments. Also, think of the endless debate between fundamental analysts and technical analysts. 90% of fundamental analysts are terrified by the crypto sector. Fundamental analysts can't use their usual metrics to study crypto companies because many of them are just in the bootstrapping phase. Since this environment is global and not regulated, crypto business can attract capitals when they are still in the bootstrapping phase. In many instances, there is no product ready for the masses. The credibility of an altcoin is in a sense the credibility itself of world top coders involved in these projects that truly want to be winners in this competitive space. Several coders working in this space are top professionals that already created software that you are probably using this moment. But when you are still in the bootstrapping phase, it's very difficult to predict if a product will be successful in the next 10 years or not. Generally, the blockchain specialists that work in the industry judge a new product simply looking at the credibility and the skills of the people involved in the project. How can you can judge the value of something that still does not produce relevant economic data? But even without data, crypto markets show the same patterns that we see on the stock market. They are almost identical. A fundamental analyst facing this dilemma will be forced to question his own authority. So Technical analysts and Wyckofians have a tremendous edge in this sector. So this is the SHITPERP, the low cap crypto index. It's basically the group of the most speculative assets within the crypto market, which is by itself one of the most speculative asset class ever seen. And monitoring the most speculative assets give you some hint about the general sentiment of the market. So this is our secret, guys. We look at the S&P, but we always have page opened with the shitcoin index. And look also what kind of structure we usually can observe in these indexes. I covered this index many times in my crypto report. Classical structure, accumulation, major sign of strength, and this is a change of behavior in the market. And basically from this day, you have seen a trading range that we explore now. And we still have to understand if this is distribution or accumulation. We want to always have some kind of confirmation. Now let's come back to the chart that I published on Saturday. The low cap index here shows an upsloping structure compared to Bitcoin, and it's already breaking to the upside. We can find a very similar story in the mid-perp index. Bitcoin and the altcoin index are the worst performer. What does it mean? What's the hidden force sustaining the price of low caps and mid caps here? That's demand. In these two indexes, there is more institutional presence in this moment, at the moment where I published the chart, compared to Bitcoin. Also look at this. The low cap index is clearing the resistance. This is a very interesting structural point. Do you remember what we said in our first session 1 week ago? You always want to pick the asset that is ready to jump out of the range. You always want to catch the emergence of the uptrend. You are always looking for that magic moment where price is sustained by demand and there is no supply on the resistance. And this is the reason why at Wyckoff Analytics we spend a lot of time studying phases. Phase A, Phase B, Phase C, Phase D. It's not just a theoretical idea. There's a practical reason, and you can immediately see the benefit of this concept. In each phase of a consolidation, price shows a specific behavior. If you have two assets, one in phase B and the other in phase D, basically we are saying that the first asset has still to fully absorb the supply present in the market, while the second is ready to fly. These dynamics are the same in the stock market and the crypto market. So we usually work, when we work with stock, half of our work is actually in the selection process. The selection process also helps you to reduce the cost of the trading business. In your trading career, you'll make a lot of mistakes, but if your selection is good, even when the market is punishing your trade, your losses will be small, and your good trades will outperform the market. And this is very important in the crypto space because low liquidity tends to create sudden shakeout actions. So especially if you are using leverage, your selection has to be extremely good. And you can't really imagine how many times I made analytical mistakes, but a good selection process has protected my account. Let me see some question. The altcoin index is generally large cap. By the way, on FTX, you can find the composition of that index. So you can look for all the assets included, the quantities, and it's very, very useful. Great. The main principle is the capitalization, but in general, you can have also indexes created by thematic buying. Let's say that there is a kind of thematical buying, kind of fashion, the crypto industry in this month. And you can see an index created just as a sum of a basket of cryptocurrency with a specific theme. Now let's explore the selection process in a very detailed way. Let's analyze these two indexes, the SHIT perp on the top and the mid perp. Look at the green spots. Let's say that you want to open a position to the long side on the areas highlighted in yellow, in green, sorry. We want to select the asset with stronger rallies and shallow reactions. Stronger rallies suggest more buying activity. Shallow reactions shows inability to go down, basically, are a sign of less selling in the market. So according to your opinion, which asset is performing better? Write down. The shitcoin index or midcap index? If you have attended the Wyckoff trading course, Roman have taught you how to compare two assets. Let's quickly recap the method. First, we identify the significant highs and lows. So we want to mark these points. We draw a line that links together two consecutive lows. Then we compare the slope of this line with the slope of this line. And the line at the top has a down tilt. The line at the bottom, instead, has an up tilt. What does it mean, guys? Why this line is downsloping and this line is, yes, the mid cap is stronger at this point. Great. There is more buying pressure in the mid cap. There is a hidden force that is sustaining the price. It's demand. So we have a part of information now. What we want to see now? We want to know if there is some selling in the market. So let's link together two consecutive highs, and then let's compare the slopes again. The line on the mid cap is almost flat. The line on the shitcoin index is downsloping. There is more selling pressure here. So the second asset has more buyers and less sellers. In both assets, we will see a rally, but which asset will outperform the market? Which asset will have the better rally? Now we have seen the mid-cap index. I think that now you see the value of this technique, because when you are trading cryptocurrencies, you should always look for relative performance. And now I will show you an example of selection from the weekly report that I write. In the weekend, while I was preparing the material for today's session, I thought, we are going to talk about relative strength, relative performance. Let's show a very good candidate on the crypto report. I want to show this methodology in action, not just historical charts. I have published this chart on Saturday morning. Look how Chainlink is outperforming Bitcoin on the last rally and reaction. Higher high, higher low on Chainlink, while Bitcoin is making a lower high followed by a higher low. This was our candidate for this week. And sometimes it's easy for a trader show many setups and then just wait for a couple of trades that work. But our goal in this class is different. We want to be very strict with ourselves because a good selection saves us time and money. And this was the result yesterday. So we want to be absolutely transparent in this class. On the intraday, this was a very good move. Even with few trades like this during the week, you can be in a good shape. Now the question is, what we expect now? Because basically we are touching the resistance of this channel. This is a very important channel. So you want to be cautious at this point. If you are an intraday traders, basically you can be happy with this profit, and it's a 30% moving one. Basically, a couple of days is very good for the standards of financial markets. For the crypto standards, you can always find sometimes someone that says, "Okay, but I want to double every day." Well, let's be realistic, guys. But today we see a very interesting price action here. Supply is coming in on this bar. So the volume here is very high. Now we want to understand if this asset, if the selling that is coming to the market will be absorbed on the way up or will just fail here. Our intraday trade or very short-term swing for now is closed. Now we want to talk about the importance of the relative strength on daily charts, weekly charts too, because comparative strength is even more important when you analyze long-term charts. So this is the long-term chart of Chainlink. This is not updated to today. Today we have this kind of supply bar here. So basically the weekly, but weekly is not finished yet. So Chainlink was performing better than Bitcoin throughout 2018. Look at the first accumulation range. 1 year the crypto space can generate very high targets. Remember, cryptos are very volatile assets. High volatility throughout the range can generate big counts in a very short period of time. We have seen this in the S&P lately. Then what happens here in April? The catalyst for the big run was the announcement of an important partnership between Chainlink and Google Cloud, which became public only after a prolonged period of absorption. Focus here on this point here. The release of the news was perfectly timed for a long entry. Buy the rumor, sell the news? Not yet, because this spot is just a major sign of strength in this long-term accumulation. At this point, CEO types are not using the news to sell their shares. They are advertising the trend. So indeed, this is a weekly chart that you always want to time your entry on the daily chart. So Chainlink outperforms the market and then forms another range. The current consolidation shows elements of comparative strength again. Upsloping range, while Bitcoin is underperforming. Look at that big shakeout here it's the COVID reaction. It still creates a higher low. Bullish, quick recovery. Bullish. I personally think that Chainlink will surprise us in the future. But I'm not in this market with an investor mentality. I think it's very important for crypto traders to think and act like speculators. But when you see such a constructive long-term formation in the crypto space, you can even think of campaigning an asset. And generally, prolonged outperformance of weekly charts tend to persist until the price cycle of the crypto market is broken. Now let's just focus on this area, this accumulation range. This is the horizontal count of the first accumulation range that we have seen in Chainlink. One box reversal, user-defined scaling. You can find a lot of information on our YouTube channel about point and figure chart. We cannot explain everything here. By the way, that material is free, so it's always there. You can read a lot of materials on Bruce Fraser blog. It's wonderful. You can clearly recognize on this chart the major sign of strength, followed by a backing up action. Now look at this beautiful count. It's a 10 bagger, and it took just 1 month to reach the target. Or a couple of months. Beautiful chart. Now let's see the current consolidation. This is an old chart. So this is the PNF chart of the current consolidation. It's not updated because in today's price action we've seen that kind of supply bar. You can easily recreate this on stockcharts.com. In this case, I've used a logarithmic scaling. Three-box reversal, 5% scaling. Look at those wide swings from $1 to $5, and we are still in consolidation. Now maybe that we are in the major sign of strength of this big formation. We are backing up. We are in the backing up action. We have to see. We have to see. But I love PNF charts in this volatile environment because they help us to reduce the noise. I see that especially very young traders in this space always think about the small moves because there's a lot of volatility in those momentum instruments. But we can even study volume price action on this chart. Look at the volume here. Let's try to read here the Wyckoff story of this asset. At point 1, we see profit taken by institutions after a massive run. At point 2, we see a slight penetration of the support on a local increase of volume. The volume here is increasing. We come back here. Short-term bullish is kind of spring, but do you want to trade the spring? I know that you can see the result here, but on a theoretical level, you want to buy the spring here? There are the conditions to buy the spring? Yes or no? No, because basically the context at this spot is still the context of a downtrend. So the odds are not in our favor. We want to see spring when you have signs of accumulation in the formation, or when they are in the uptrend, like here. But this is not the best place to buy a spring. Point 3. Climatic action. Look at number of O's, high volume, extreme oversold. quick recovery. Point 4. We see a retest here of the low as a higher low on lower volume. Supply has been absorbed. This is bullish, and this could be on the intraday, not on this chart, a short-term opportunity. Price get back to the previous value zone. This was the value zone for Chainlink. But we still have to build a bigger cause in order to break the long-term resistance. Price fails to commit above this resistance, this level, and then comes back to the support. Point 5. Very high volume, but we make a higher low compared to point 3. This is bullish or bearish, guys? It's bullish. This is very bullish. Buyers are buying this asset, are coming in. So bullish action confirmed by a quick reversal that leads us to the top of the prior significant down bar. Here. So you identify a down bar here. This is basically a down bar. It's not red, but it's a down bar with a column of O's. And then what we see after the recovery? The lowest supply signature of the whole consolidation. Basically, price is suggesting to you, we have seen demand. Demand was not enough to break out this level of supply. Then we see more demand, we see a recovery, and we see no supply here on the top. And this is extremely important because you always want to know that you have demand on the bottom and no supply on the top. So this is a very nice opportunity. You can trade this on the, like on intraday, on vertical charts, not just on the PNF, because it's difficult to trade directly from PNF charts. It's possible, it's a great opportunity to do that, but for now we want to just focus on this instrument like an educational tool for now. So the lowest supply signature in the whole chart. Higher low again, the local resistance becomes support. Point 6 is a very tricky point. We see a local trading range with a break in the middle. We quickly recover, we make a higher high, but there is still a significant amount of supply. And we are on the long-term resistance here. We would like to know how much supply is still there at this level. We have a test which is bullish, but we want to see a very consistent absorption. If this formation is truly bullish, you want to see higher lows and higher highs and then acceleration to the upside. So basically, you want to see some kind of testing action on the top of the formation and then a breakout that confirms that this is another accumulation. Instead, it breaks. And this is not what we want to see. So this huge bar is the COVID reaction. It's a dramatic shakeout, but still a higher low, a slightly higher low compared to point 3. On the vertical chart is more clear. A higher low. This is much better the price action of the S&P. Low cap, low liquidity cryptos holding better than the S&P during this dramatic liquidity event. Relative strength, comparative strength, demand is coming. On the next bar, in fact, we see a huge automatic rally. But the bias of the formation is still not clear. What we see next? This is a sign of strength bar, followed by an LPS, a last point of support. Now let's look at a very high volume signature on the last rally. Compared to the vertical charts, on this volume, on the PNF chart, it's basically a cumulative volume. We see high volume, but on the down bars, the supply signature is muted. How do you interpret this? It's very tricky, and each time supply comes in, it's quickly reabsorbed. I think that if we start to see increased effort to the downside associated by increased result to the downside, that will be a signal that the backing up action is starting. And what happens the following days? Today, basically we see a bar here, a supply bar, and we still want to see if it's possible to see some kind of absorption at this level or not. So many traders are just screaming, this is the upthrust, definite upthrust. No, we want to see some kind of confirmation because it's not automatic to see a kind of failure here and then price falls to the support. We want to see some kind of confirmation because absorption can always happen at higher prices. So now that you have explored the basics of a selection process, let's practice together. Here's a very interesting exercise. So the bias of the market is to the upside. You want to open a long here. Which asset will outperform, A or B? Which asset will have the best rally? I'll take a short break, just 1 minute, but in the meanwhile, please type your answer. Asset A or asset B? 1 minute. So the majority of you has said B. Here's the solution. B, Bitcoin. So good job. So the message here is that when you are trading on the intraday or just you are doing a very quick swing trade, you always want to look for the short-term outperformance. In this case, we switch from the leadership of the asset, switch from Chainlink to Bitcoin. This kind of rotation between one asset and another is very common in the crypto environment. And we will discuss this in the next session. Now let's talk about a very important concept. This is my favorite part of the webinar today. Let me know if you have any questions about this chart, by the way, before going next. Okay, good. So this chart is clear. Close your eye and think of an uptrend. I'm sure that 90% of you is thinking of a trend like this. When we think of trends, we always have in mind this kind of orderly moves, almost square ranges, almost perfect trend lines, and so on. This is the S&P on the intraday. It's not the current price action. This uptrend preceded that scary COVID reaction. We miss a part of the distribution here. But everything looks so textbook on this chart. Why? Because every day a huge number of institutions trade this instrument. This is one of the most liquid financial instruments in the world. And the constant participation of big institutional traders tend to create orderly trends. Many Wyckofians trade this instrument because it works in a very orderly way most of the time. Now just a very flash quiz. Look at the consolidation here with the shakeout in the middle. We have already seen a consolidation like this in our first session, when I was discussing the market history of Bitcoin. Do you remember the China ban story of Bitcoin when Bitcoin miners were forced to relocate their business? Here's that consolidation on the daily chart. Look how similar they are. Notice that shakeout action followed by a quick recovery. Here and here. And we are comparing an intraday chart with a daily chart. At this point of your journey into the Wyckoff methodology, your brain starts to catch analogs between different charts. And I hope that, especially now, you can see the value of studying historical charts, because markets always repeat. Then let's see now another financial instrument. Momentum instrument, very interesting price action, is Tesla. Multi-year formation that out of sudden wake up, momentum starts and we see an uptrend with extreme acceleration. This reminds me a lot of Bitcoin moves. But how do you draw a trend line here? This is the weekly time frame. Let's switch to the daily. How do you draw a trend line here on this historical chart? You look at daily chart and think, too much momentum here. Conventional trend lines don't work here. But I attended a webinar some time ago. This guy was talking for hours of Bitcoin. We were analyzing an old historical chart of Bitcoin from $2,000 to $20,000. I remember that the trend was much more manageable using a log scale, like this. And there is no doubt that log channels are much more useful than conventional trend lines for this kind of momentum instruments. Here's an example of a reverse trend line on a logarithmic scale. You start linking together two consecutive highs, then you identify the low in the middle, and you establish the channel. Even in this log channel, you can see that at some point, the stride of the trend changes, and we have a climatic action. At point 1, here, the supply signature increases, and we are close to the overbought condition of the trend. Here. What can you do here? You can exit your position. Of course, you can exit your position. However, it's a very common mistake to exit your position just because we are in the overbought condition, especially in this kind of instrument, where we see a prolonged period of inactivity and finally buyers come on the way up. In fact, at point 2, supply is lower and price breaks the old trend line. We are now following a new trend line, and the trend continues until we see a huge climatic move. And this is a log scale, remember, so this is basically a double. If you exited the market at $500, the market has punished you because of your poor knowledge of supply and demand dynamics. And that's just my personal opinion, but I strongly believe that the crypto market and momentum instruments in general have no mercy for people that want to just mechanically apply a set of rules without understanding the true dynamics of supply and demand. Every time we get punished, we tend to think things like it's a game of probabilities, it's the cost of trading business, just wait for the next spring or the next uptrust. This behavior, especially at the beginning, will lead you to have poor performance in an extremely speculative market. So be strict with yourself. So we have studied trends on the S&P, on intraday, on Tesla. Now let's look finally at Bitcoin. So we will review this run consolidation on the bottom later. Now let's just focus on the uptrend. If you just want to use a conventional trend line on the arithmetic scale, it doesn't work. Let's switch to the logarithmic scale. Look how orderly this uptrend looks now. This is a chart that I sent to Roman and Bruce 1 year ago, and they've commented this chart in the weekly market discussion. I think that you can recognize Roman's marking on the top. If you don't know the weekly market discussion, please go to our YouTube channel and just look for some episode for free. It's such a great source of knowledge for Wyckofians, and you can see there all the principles that we teach in a live environment week by week. And the stock market is very similar to the crypto market. So what was the idea behind this chart? We see two reaccumulations, this and this, and then a climatic move from over the log channel and climatic characteristics. This chart does not show a change of character yet, but the extreme volume at the end of the chart is screaming, be more aggressive with your stop loss. The stopping action could be behind the corner. What we do in these cases? In this case, you raise your stop loss, and just in case of a sudden reaction, you are not sacrificing the gains that you had on this beautiful climatic move. If you are new to the methodology, Roman teaches all those techniques in the Wake of Trading course part 1 and 2, and there are entire sessions about this topic. By the way, let's continue this kind of parabolic move. At this point, you feel very confident about your analytical skills. You are going to apply logarithmic scales everywhere and just enjoy the trend. And here is where the market gives you a slap in the face. What about these high momentum instruments? These are basically mid caps, low caps, crypto market. This is Grayscale Ethereum Trust. It's a very interesting instrument. It's traded on the OTC market, so it's not a crypto. It's a basket of it's a kind of ETN. But the behavior of this price and volume is basically the same, that cryptocurrency. These are the most speculative instruments within the most speculative asset class in the world. These charts are the reason why today you are spending a couple of hours of your precious time in front of a screen. Someone could say, well, these are very small caps. It's a very manipulated market. This is a kind of nest environment with its own rules. So the same rules that we can apply in every day in free markets are not valid here. Free market. Please erase these two words from your vocabulary. No market is really free. The creation of value is not a simple algorithm. It's a complex mechanism. And even on a theoretical point, a good market is not a free market. A good market is a liquid market. It's a market where participants, big institutions, can operate on a daily basis. They can make money, lose money, but they stay in the system. They don't stay on the sidelines. And just think of the action of the Federal Reserve today. They are not just pushing up the price of assets. Their goal is to preserve the condition of liquidity of the market. Liquidity attracts more liquidity. Illiquidity scares market participants. And the quality of the market participants changes according to the condition of liquidity of the market. We know that very illiquid assets will never attract trillion-sized composite operators. But the principle of demand and supply are the same. Now, how can we catch these beautiful momentum moves? Using a simple trend lines on a logarithmic scale is not enough. The conventional channels that we draw are not the best tools here. But this is not a valid reason for giving up, guys. There are a lot of speculative opportunities in these small markets. For example, let's look at this chart. This is Republic Protocol. We have discussed this chart in the crypto report many times in the past. Usually in the crypto report I focus only on the major assets because covering 3 or 4 assets in depth already takes me a lot of time. But in the future we'll find a different formula, a more dynamic format to cover the small cap universe too. So don't worry. What we see in this chart? We see 2 10-bagger moves in a very short period, just 3 months. Unbelievable. No, it just happens all the time in crypto markets. So let's quickly analyze this chart. I can't ask you because what is this chart? What do you see here? Because I just labeled here. So, by the way, accumulation, first accumulation, major sign of strength, baking up action, and then a 10-bagger in just a couple of months. Distribution. Then another cycle on the top of the previous value zone. 2 months, another 10-bagger. So we want to trade this chart. We want to be active in this market. Now let's look at this chart. This is an historical chart. So what happens to beginners in this space is that they have a 10 bagger in front of their screen and they are not able to squeeze all the profit for this move. The paradox is that this kind of move is a kind of dream for campaigners. And campaigners are traders that stalk long ranges, identify big causes, calculate PNF counts, and say, oh my gosh, there's a lot of potential here. This is a silent monster. And then they add the position on a rising scale. And when I see this chart, I always think of Professor Bruce Fraser, that very often in his blog and in weekly market discussion shows us very long-term causes of commodities, huge PNF counts or multi-year accumulations in the stocks and so on. These patterns are typical of multi-year accumulation, low-cap stocks too. When at some point of the business cycle and the money cycle, they explode out of sudden. And generally, when we see these long-term charts, we think, yes, it's a fantastic count, but it will take years to fulfill the targets. Then you totally discard these long-term charts. And then when you go to the crypto market, you are not able to recognize in what kind of environment we are. So this is a market where professional traders can make a lot of money just operating on intraday because there's a lot of volatility there. But then there's a 10 years old child that come at you and say, I bought this small cap crypto asset 3 months ago and now I have 1,000% return. And then you say, that's just the beginner luck. I'm a professional. No, the child is right. Maybe he didn't know what he was doing, but at the end of the day, he made the right decision at the right time. Because in this very speculative market, the right decision at the right time outperform all the other markets. So this is kind of ideal behavior of weekends during such a speculative run. When I talk about weekends, guys, in a lot of instances, it happens to us to make mistakes and act as weekends. No one is invincible. The first big mistake here is not being able to recognize the huge potential of this very long accumulation. In this case, even a basic strategy can give good returns, but we have to identify first the potential of these structures. Point number 2. You look at this structure and you think, this looks climatic. The move is done. While that move is actually a major sign of strength. Point 3. You are out and you miss a big part of the trend. And then when you realize that the uptrend is continuing to go up without you, you decide to re-enter the market. And this is the moment where you realize when you make a lot of mistakes because volatility is very high, and you tend to show that kind of revenge trade behavior. I've been out, now I want to make profits. This is a kind of extreme example, but no one is really immune to this logic, even professionals. So we want to be aware of these psychological dynamics and also understand that visual patterns can trigger bad behaviors. Lines, geometrical patterns always trigger our emotion. We are all visually illiterate. This is not a quote from Wyckoff. Rembrandt said this. We have said that volume and price analysis can explain whatever price action. But when we look at this magnificent structure, we feel a bit lost. It's a kind of big construction without pillars. How is that possible? A great advice. When there is an aspect of price and volume that you don't understand, always go back to the basics. So let's dissect the anatomy of this move. Just one moment that I check the questions. The crypto report is basically free. So every Saturday on our Twitter profile, you can just check that, and on our website, it's very easy to find. So, and it's totally free. We don't ask money for that. So every time I watch these parabolic moves, I think of this story. In Florence, in Italy, you can find the biggest dome in the world. Domes are generally built using a central axis support. But Brunelleschi was a great innovator and built a gigantic dome, the biggest of the planet, without using a central axis support. Today we know that Brunelleschi did a pioneering job calculating the distribution of the weights, and even the bricks of the dome are aligned following specific patterns. And Brunelleschi was also the inventor of the perspective, so he was considered by his contemporaries a kind of illusionist, a magician. And the anecdote tells that the visitors spent hours and hours thinking, how is that possible? Maybe that there is some kind of invisible support that we don't see. And they were looking at the wrong place. The same thing happens when we are in front of our trading station and we see those 10 beggars. Where is the trend line? And the answer is the same. You have to look at each brick of the structure, each bar. And this is what we will do today, together. So please look at this chart. This is a daily chart of Apple. By definition, when a market shows good condition of liquidity, lower prices tend to attract more and more market participants. So look at this beautiful automatic rally. A giant bar that tells us that there's a lot of institutional demand for this asset. Value buyers had their bid in the $90 area. When price falls into that area, we see a quick and violent bounce. We are talking about Apple in 2015. So this asset was a must for money managers. Usually for money managers, the question is not to be or not to be in Apple, but at what price should we increase our position? Look how in this case the consensus of investors around this price zone is very, very high. In just a few hours, Apple is sold out. Look at the velocity of this huge automatic rally. As usual, The selling climax and the automatic rally defines the boundaries of the trading range. And you can find this, this is a buying game. You can find this basically on a website for free, and I think it's a very, it's a great tool to understand the logic of supply and demand. And there are tons of this on our website, so feel free to spend your time and on something that can help you to understand supply and demand with a lot of example, practicing, and so on. The stopping action does not necessarily have to have an acceleration to the downside, followed by a quick automatic rally, like in this case. Let's look at this price action. We see high volume on this big down bar, and then momentum decelerates. High volume, and then deceleration. The down move keeps going on for a while on narrow spreads and decreasing volume. Why this happens, guys? Just type your answer. Yes, supply is decreasing. Yeah. Other answers? Yes, there is absorption on the way down. Great. So it may have happened to you that when you're driving in the rain, you gently hit the brake, but the road is wet, the friction to ground is low, and then the car keeps on moving longer than expected. Aquaplaning. This concept reminds me of this kind of stopping action, with initial activity and then deceleration. Why this particular stopping action is so important for me? Because many times the stopping action not only defines the boundaries of the range, but also defines the way price will potentially move in this trading range and even the uptrend. Let's explain this. Where there is the majority of buy and sell activity in this stopping range, in the stopping action, guys? Tell me the day where we see a lot of buying and selling. It's very easy. Here, on this bar. On this bar, we see the majority of buy and sell activity. High volume and spread. We do not see any demand tail. It doesn't matter. What's going on in the lower part of the trading range? Are lower prices triggering more selling? Not for now. The majority of sellers have already sold on this bar. Supply is temporarily exhausted. Are lower prices attracting more buyers? No. Why this happens? Some institutional buyers have already bought on this bar and they are okay. Other buyers can't buy because we just said that the selling was temporarily exhausted and institutional traders need a lot of liquidity to enter the market. If the sell order is thin in this area, they have to stay on the sidelines and wait for another spot where liquidity will be present again. Where will be this area of liquidity? probably at the same level where we have seen a lot of activity before, in this range. So the price action flirts with this level without committing above it. This big supply zone is like a big wall that we are slowly breaking down. At the end of this process, a big up bar tells us that the absorption process is finished. Now let's see the same principle on an intraday chart. This is an intraday chart of Roku, a very popular stock. Do you see any buy on the bottom of this structure? There is some buying at the beginning. Then the lack of selling by weekends each time pushes price into the previous selling zone, where weekends release the last chunks of supply to strong hands. So supply temporarily overtakes demand and price falls with less and less velocity, with no ease of movement. Despite of the supply released by the weekends on the top, price is not able to break significant levels of support. Now let's come back to Bitcoin. Here is our round structure. So you can label this like a classical accumulation. Selling climax, automatic rally, and so on. But let's forget labeling for a bit and just focus on price and volume. Why this formation is so beautiful? Because on the left, market participants, on the right side of the chart, market participants are forced to absorb supply on the way up. Look at this bar. Unusual volume push, but the close is in the upper part, here. Usually, when we see a lot of volume pushing against the supply area, we are very cautious. But in this case, we know that buy on the way up is the only possible thing that even strong hands and trend followers can do, because liquidity is in the upper part of the formation. And what happened next? Price consolidates in the upper part of the bar. Now please look at the area highlighted in yellow. What do you think about the volume, guys? There's an uptrend, so you know that this is not a distribution. But when you see this kind of high volume signature, do you think it's a distributional range? Just type yes or no. I'm scrolling on the answers. Okay, yes. So the supply signature in this consolidation is quite high. But this character is not distributional. Volume is high because market participants are absorbing a very important supply area, this area. Did they absorb the supply in this area in phase B here? No. So please not make this mistake. Volume is high because market participants are absorbing this area. So the old story of the battle between buyers and sellers in phase B here is not good. In phase B, we see a minimal amount of absorption. The majority of absorption happens on the end of formation, on the way up. Look at that upsloping range. What is suggesting to you this kind of up tilt of the structure? They want to buy at any cost. And this is the secret of that beautiful acceleration that we see every day in the crypto uptrends. Absorption on the way down in phase A. Inactivity in phase B. In phase C, generally, we do not see a spring of support. Absorption in the top half of the range, which indicate by itself strength, and in the end of the consolidation, market participants are forced to enter on the way up. They were out, and now they have to come in and accept higher and higher price each time. This is the secret of this magnificent doom. Look how the backup action is a range itself. Let's jump on the 4-hour chart. This is a classic reaccumulation range. Look how shallow it is. The change of character at the beginning is very small. Buyers are accepting higher prices. On the top of this range, the backing up action is another range. Another range on the top of the accumulation range, on the top of another accumulation range. So supply emerges each time, but other market participants that were out of this market come into the market and claim, I want it at any cost. And we see a reaccumulation on the top. So this structure is not unusual. Here's a monthly chart of Apple. Do you recognize the same pattern? I think yes. I think so. Buyers are absorbing the supply on the way down, in that big supply, on that big supply bar. But price continues to go down on less momentum. And if you think about this, that big bar is the big crash that we had in the market 20 years ago. Probably this bar is not telling us the story of a massive distribution activity by institutions. Some institutions took profit, other big market participants were buying, but the liquidity of the market on that month was so poor that even strong institutional buying can't prevent price to go lower. Just for a bit, with that kind of deceleration, but price went lower. They were driving the rain. They gently hit the brake, but the road was wet. Aquaplaning. Now let's see this strange round structure. Finally, on small crypto caps. Look at the crazy price action at point 1. It's the ICO pattern. The universe of cryptocurrencies mimics the traditional stock market dynamics. The initial coin offering mimics an IPO, which is the initial public offering. So the initial coin offering is a sophisticated process involving financial players specialized in this new asset class. We have startup incubators, underwriters, crypto exchanges, and marketing companies that work together every week to launch a new crypto project, a new crypto token. And crypto tokens of cryptocurrency are almost the equivalent of shares in the stock market. But the ICO is a kind of self-regulated process. What's the consequence of this? The valuation of a cryptocurrency during the ICO process is generally totally off. We have projects that once are listed on a exchange, crypto exchange, have a 90% correction. 90% correction. And recover after many years. So Bruce has discussed so many times the IPO disease in the stock market, where an asset after the IPO goes throughout an initial phase of speculation, then price crashes and spend a long time accumulating at very low prices. Another factor that concurs to create this kind of pattern is the fact that the crypto ecosystem is all about new projects that are continuously created. Because it's very easy to create a crypto company, but it's very difficult to create a very competitive project. So point 3 here, so this is the basically the action that follows the ICO. So a lot of speculation and price quickly comes back to the initial point. Classic IPO. ICO, sorry, non IPO. Point 3 is the last significant number. We see some increase of volume, a stopping action, and the trading range start. What do you think about this price action? It's bearish or bullish, guys? Please write. Yes, someone is saying bullish, bearish, 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 bearish. Well, we don't like this price action because it looks like a break to the downside. But we don't want to trade this asset right now at this spot because it's a very illiquid asset. Then we see this kind of break. There's a lot of activity. So for now, on this bar, our bias is to the downside. We just don't want to trade, but we'll never buy this asset this day. This is not a good spring action because the asset is very illiquid here. What a strange stopping action here. What do you see here at point 2 and 3, guys? A lot of volume at bar 1, then deceleration. Interesting. Let's go next. Look at the green box. This is the pattern that we love. Absorption on the way down at point 1. Here. Then inactivity in phase B. And finally, buyers are coming. Absorbing the supply on the way up. But we want to see some kind of confirmation. For now, we don't have any kind of confirmation because we want to see a full absorption on the supply present at this level. Finally, buyers are coming, and they are absorbing the supply on the way up in the area of the big supply bar. The volume is extreme, but look at the reaction here. Why this reaction for now is bullish, guys? Because it's flat. Yes, this is a trading view chart, absolutely. It's very easy because okay, good. It's an old question that I'm looking. Okay. So volume is extreme, but the reaction is flat. What's the next resistance level, guys? Please type what bar. You can see, just say, write the month. What bar offers the next level of resistance in this trading range? Generally, you look for the top of the last significant down bar. Here. Now please look at this volume zone. To the beginner, it looks distributional, but this is vertical absorption on steroids. It's the same pattern that we have seen on Bitcoin. So the trend is forming, but if we try to use conventional trend lines again, we will fail. Why? Because we are missing the big picture. Again, same principle. Look at how many market participants are coming here. And price don't want to fall. That's beautiful. If we just start drawing lines in this way, in a liquid asset or low liquidity asset or whatever you want, we will fail. This is not a chart to the S&P. A logarithmic scale is just a first step. But there is another way to draw this kind of expanding trend. Remember, always go to the basics of the methodology. Please do not assume anything. There is always some nuance of the market that we still don't know. Remember, it's not geometry. It's all about price and volume. So, flash quiz. What's the basic definition of the uptrend, guys? Very basic questions. An uptrend is defined by high highs and higher lows. Very basic definition, okay. But in Wyckofian terms, what's an uptrend? It's a sequence of higher lows where we see high effort to the downside and down result, a low down result, for example in the spring here, or we see, like here, a small up effort volume that produces a very good up result. In the same way, in an uptrend, we want to see higher highs where supply comes in, but this supply does not produce a significant result to the downside. In other words, higher highs in an uptrend are supply points where selling does not produce a lower low in the structure because the supply in excess is absorbed. This is a better example. So at point 1 we see a spring in the trading range. Down effort, down result. High effort, low result, bullish. Then at point 2, a major sign of strength. Supply comes in, but it's quickly reabsorbed. point 3, supply comes in, point 3, we see up effort and up result. So a minimal effort, just some buyers coming in the market, the price runs. At point 4, supply comes in, local top absorption, and so on. But Wyckoff noticed that sometimes trend lines were more effective, reverse trend lines were more effective than just conventional trend lines. So basically they started linking the local tops of the trend. Reverse channel, very easy. But let's forget the geometry. What's the meaning of this in terms of volume and price? Let's translate these higher highs and higher lows in Wyckoff language. The highs, highlighted in blue, here. So the reverse overbought trend lines start from the point where supply came in and didn't produce a significant result to the downside. A lot of supply, but still a high high. The stride of the trend is assigned at point 1, just at the beginning of the consolidation. But look at this pattern here. Look at point 2. We have discussed this pattern at the beginning of the discussion. What's going on at this point, guys? Strong hands are absorbing the supply on the way down, and then nothing happens. Deceleration and acceleration to the upside. Deceleration. Phase B of this local trading range is very quiet. Buyers are forced to come on the way up. And now finally we can talk about this beautiful chart. So our initial problem was, how can you draw the trend lines? Conventional trend lines don't work with this. Let's think now of the concept of trend lines, not just the geometry. We have said that reverse trend lines start at the points where supply comes in and does not produce a significant result to the downside. What's happening on this formation? Look at the volume signature. We see a lot of volume on the right side of the chart. Is this distributional? No. We see two good rallies here, and then flat reaction. Now think of the whole formation, the whole training range. The volume is focused on the right side of the chart. If this price action is a part of a big trading range, we have phase B with a lot of inactivity. So phase A, phase B inactivity, then an oversold condition where price and volume suggest a more active accumulation. And then when the market participants realize that there is a potential uptrend, they are forced to enter on the way up. This kind of absorption is called vertical absorption. In the crypto market, vertical absorption is extremely common. So if they want to buy, if they want to be in, they have to accept higher prices. Their inactivity in this long phase B suggests that at some point they will have to absorb the supply on the way up. All this hurry is a consequence of the inactivity in phase B. So the market is like an elastic structure. Usually we talk about the elasticity of the market as a kind of a proportionality between the calls and the targets. Like this is a huge cause, so the target will be very high. But there is also another level of elasticity in the market, in the horizontal direction. These are not conventional trend lines. Basically, we are identifying the previous points where supply was coming in the formation, and we draw parallel lines from there. It works. But why? What's the logic behind this line? Let's come back to the definitions. A reverse trend line starts from a point where supply comes into the market, but does not produce a significant result to the downside, because absorption is in play. So in this case, we are projecting this line from supply points within the trading range, where supply has been absorbed on the way down, especially here. Supply absorbed on the way down, the inactivity, and the same story. Supply was absorbed at the top of the formation, because throughout this range, liquidity was so poor that these highs were the only spots where market participants could exchange a lot of shares. So the market is like a rubber band. The price action of the past does not necessarily contain the future, but it indicates a kind of path that buyers have to follow if they want to enter this market and absorb the supply that is present at specific levels. Maybe that at some point the fundamentals of this asset will change, something bad happens, and market participants change their idea about the cryptocurrency. We cannot predict that. What we can say, however, is that if the buying pressure on this asset persists, buyers will be forced to accept higher prices, and price will move into that path. Trading is not about predicting the future. Our goal is just create scenarios and trade low probability scenarios. So we can't really use this principle for every kind of consolidation. But the trick is that when you have a big range with a phase B with a prolonged period of activity, and this situation is very common in cryptos, and you expect buying on the way up out of sudden, this technique can help you a lot when conventional trend lines are not useful. Roman sometimes used this technique in the practicum course, and it's not a new technique for people who work of analytics. I'm just explaining this concept in the Wyckofian sense, because behind the geometry there's also always the logic of price and volume. And I hope that you can use this technique in a very practical way once you have understood the dynamics of demand and supply. So this is the full chart with the Wyckoff labeling. So I want to show here just the minor sign of strength, because we are committing above this resistance. Is a downsloping range, and this downslope is caused by the liquidity itself. It's very poor. And buyers then are accepting higher prices, are absorbing the supply on the way up. We clear the level of the resistance, this last level, and then we run. Always remember, when you clear all the levels of resistance, there is no obstacle. So we can run. This chart is from the past cycle, but we can see a lot of charts like this in today's market. In the next session, we'll make together some exercises. Now, guys, a very short quiz. What's the name of this cryptocurrency? It can be Bitcoin, low caps. It's a low caps, guys. Just say yes or no. It's a beautiful cryptocurrency invented in 1985. This is a stock. Apple. Monthly chart. So you can see how many similarities you can find between this monthly chart of stocks and crypto charts on the daily time frames. So monthly time frame, daily time frame on the crypto market. And generally, nobody want to study this monthly chart because we are young, we cannot wait for 40 years to see the end of a consolidation. Of course you can't. But immature markets have accelerated price cycle. The same price cycle that you see here and took decades on Apple, the same formation develops in a couple of months in the crypto world. And the more I trade this market, the more I think this is a market populated by intraday traders. And we will see in the next session a couple of examples of intraday trades. But it is also the paradise of campaigners, traders that think in terms of long-term formation. But the irony of the fate is that you cannot just say, okay, I see a long-term accumulation in this asset, I'm going to buy. Because in many cases, the crypto companies are so immature that anything can happen. So look at the market as a campaigner, act like a speculator. And now I feel the responsibility to show you this chart because I know what you are thinking now. That stopping action with deceleration is so common in crypto market. So you identify this pattern and you start thinking about this fund formation. No, Wyckoff is not about geometry. This is just the stopping action. You have to follow what happens next. You must follow the story of volume price, the Wyckoff story. For example, what happens here? We see an uptrust, high effort to the upside, a lot of volume, low result. We barely commit about the top of the big down bar. We fail. Not good. So in the next session, we will focus on several strategies decided for many kinds of traders. And we'll talk about also the rotation in crypto market. It's a very hot topic because in this market, capitals rotate in a very fascinating way. So any question for the end of this session? Let me check. Okay. Okay, guys. So appears why this may be aggressive. Okay. As for the hypodermic top, I think that you don't have to think in terms of simply a percentage because it depends from the structure. Let's say that you have an uptrend kind of huge correction, then a recovery, and another big correction. This is a typical behavior of momentum instrument. So the risk is that you can just call for the hypodermic each time. For this reason, you always want to see what's going on the bottom of the formation. Are we going to see some kind of accumulation and another attempt to commit above the resistance? Or the trend just failed? Generally, after an hypodermic formation, we see a kind of apex formation where the volatility of the asset diminishes, the volume diminishes as well. We see a last attempt to commit above the resistance on the middle formation, and then price fails. But I can show you some kind of schematics or even just real cases in the last session. Thank you very much for your question. So the stop losses, moving the stop losses in the crypto environment could be, yes, moving the stop losses in the crypto environment is very, very important. You have to be very quick, especially this kind of asset. But we are talking about Tembecker, so at least they reward you when they move. Because this market is also the place where we see a lot of inactivity and then sudden activity. So basically, you have to be ready for the price action, and you have to be a pig. We say that you have to profit when the market is moving. We have to be extremely active to identify the level of the support, the significant level of support where we want to place your stop losses. But we will show some example of this in the next session, don't worry. So, okay. Well, thank you very much for your feedback, guys. I hope that this lesson today was a good lesson. So thank you very much, and please send me your feedback, any questions. So in the last session, we can explain more concept. We can reply to all of your doubts. Thank you very much, guys. Bye-bye.